So we're mainly dealing with service-based businesses here. So I can kind of tailor that. Another one. Okay, perfect. So I can kind of tailor that to the service-based business space. So I want to start with a disclaimer. This is not about investing. This is not about wealth building. But this webinar is probably going to put more money in your pocket each year than any other investing or wealth building book. I myself, and I'm sure many of you have been on webinars that are a lot of fluff, a lot of theory, and you left feeling like you learned nothing. I wanted to make sure that I put the most valuable content that I could within this 1 hour period. So I'm really excited to share the wealth of information today. The last one, number 5, is the mistake number 5 is probably my favorite tip that I use with all of my clients when I'm reviewing monthly with them. I know we have some CPAs in here as well. So I think this will be useful to share with you as you're reviewing with your clients. A big part of that motivation for these mistakes is simple numbers. If you guys haven't read the book Simple Numbers by Greg Crabtree, this is going to be revolutionary for your business. I don't know if anyone's read this book yet. Go ahead and put yes in the chat if you've read this. Phenomenal book. Okay, let's go ahead and get into the content. So first thing, just as a professional measure to share my background on who I am, just so you have a validation, the information comes from a credible source. I've been working with small businesses in the accounting industry for over 8 years. At this point, I've worked intimately with over 80 small business owners. My first job after graduating University of Tampa, I had a portfolio of about 20 small businesses in Tampa, Florida that I worked with. We handled everything, their financials, bookkeeping, bill pay, payroll, monthly analysis. It was amazing for me as a college kid because I would go to these restaurants and sports bars, and I would be thinking, it'd be really cool to see the back end of this company and know how it operates and what their financials look like. And 2 years into my career there, that exact owner of the sports bar I was in when I thought that was my client. And he was asking me, how should I price the chicken wings in my sports bar? So it was a surreal experience. Being able to work with small businesses has been amazing, and just so much knowledge in so many industries that I've been able to learn from. After that role, I worked as an auditor for the federal government for a while, and then I transitioned into auditing Fortune 500 companies at one of the big 4 accounting firms. So whenever a public company like a Coca-Cola issues their financials to the public, they have to be audited by a third party. And that's where I came in. I was a part of a 30-person audit team. These are very, very big companies and massive audit teams that audit these financials before they're publicly available to trade. So as a senior accountant there, Coca-Cola, L3Harris, some of the big aerospace companies down in Melbourne, Florida that I worked with. On the right there, you can see a picture that I took of the Coca-Cola warehouse. That was an inventory account I did at 5 a.m. Brutal. And then at the bottom is a rocket booster made by L3Harris, one of my main audit clients, who sells to NASA. So at the top right, you can see that picture of the space launch we went to go see late at night at the Kennedy Space Center. Amazing experience. I also serve as the treasurer for our local Toastmasters International chapter in Florida, and I'm a business advisor for the Small Business Development Center at the University of Central Florida. And again, I don't say this to boast. I just want to give a bit of my background so you know the info today comes from a credible source. Okay. And then in terms of about me personally, I've got 2 dogs, Sake and Moche, and my beautiful partner, Mariella. She's a professional model, winner of Miss Latina Tampa. She also knows her debits and credits, and she's a part of Stronghold Accounting, has been a part since the very beginning as a senior accountant. Was originally born in Honolulu, Hawaii, before moving to Florida. Big martial arts fan and trained myself, boxing, Muay Thai. Getting into steel shooting. I don't know if anyone's into steel competition shooting and clay shooting, getting into that. And then there's a picture of our recent trip to Japan on the bottom right. For 2 weeks we went. So looking for some more travel destinations. If you had any good places in mind that you went to recently or you would like to go, drop in the chat. I need some great suggestions for the next vacation. Okay, let's get into the agenda for today. So the first half, we're going to talk about tax strategies, okay? And then the second half, we're going to talk about optimizing your profitability. And then we'll wrap up with a recap and a summary at the end. And I want to preface this with the data you're going to see in this webinar is real data from real clients, anonymous data that I've gotten permission to share. So this is no theory. This is practical tips that I want to share with you today. So I just want to put that out there so you know this is real data. Okay. let's go ahead and get into the tax saving piece. Okay, mistake number one, not turning your business into a tax deductible gold mine. So, question for everyone, because there is a common misconception. Who has a higher tax rate? Your regular LLC business owner or a W-2 employee? I'm going to put a poll for everyone to answer this. Okay. Who has a higher tax rate? W-2 employee or your business owner, like your typical LLC, sole proprietor business owner? Any idea who pays a higher tax rate? Okay. Everyone is saying W-2 employees. This is why I wanted to do this poll. So business owners, LLC, sole proprietor owners are actually paying a higher tax rate. Okay, now someone answered, oh, okay, now people are transferring to business. Okay, so why is that? Why do they pay a higher tax rate? Because they must, as you're a self-employed individual, right? You are your employer and your employee all at the same time. So you actually have to cover the employee portion of payroll tax and the employer portion of payroll tax. So you're paying double the amount of payroll tax compared to your as if you were an employee. Because when you're an employee, your employer is covering half of that for you. So a lot of people don't actually understand that. So you might say, okay, Alex, well, then why did I become a business owner? I thought I was going to be saving on taxes. So let me explain, because there is a hidden advantage. Although LLCs have a higher tax rate, there are two ways to mitigate this. Number one, optimizing your entity structure. So you may legally be an LLC, but there are way more advantageous ways to be taxed. Just helped a guy save $70,000 yesterday on a phone call because of this exact problem. Number two, capturing ordinary and necessary expenses in the pursuit of income. Even if you're a real estate agent, if you get a 1099 and you are technically, your own business owner, you can deduct reasonable expenses towards the pursuit of income. That is the key advantage, because you're taxed on that net amount. You're not taxed on the total revenue. So if we can capture those additional deductions, it's going to push down the profitability in the overall tax that you're going to be paying, even though you're at a higher rate. Does that make sense to everyone? Type a yes in the chat if that kind of makes sense the way I explained it. We're going to dive a little bit deeper just so you can see a visual on this. Okay, first, let's talk about S corporations. This is massive. If you're running a business that produced at least $50,000 in profit, and let me move to the next slide after this, $50,000 in profit, I need you to note down right now to ask your accountant, have I decided to elect to be taxed as an S corporation? Let me move to the slide now. Okay, 50,000, that's the threshold. Net income, not revenue, net income. Why is this so important? S corps are one of the most powerful entity structures that exist for most businesses. Then that magic threshold is that 50K. So this slide has a lot of numbers and arrows going on, but it's very simple. This is one main takeaway that I want you to understand from this. You can see on the left, your normal LLC is going to pay $22,950 in self-employment tax on 150K in net profit. Okay, that's example one. Scenario two on the right-hand side, if your LLC elects to be taxed as an S corporation, that same exact $150,000 in profit is now paying $6,120 in self-employment tax. That is a that's a $16,830 difference. And remember, this happens year after year. This isn't a one-time thing. This is every single year. So that's exactly the scenario that I helped this individual save $72,000, because he was filing the wrong way for the past 3 years. And by the way, you can retroactively go back to 3 years and change the filing status to an S corporation. So massive, massive amount. And people just don't know this, that $50,000 threshold. The one guy I talked to yesterday, his CPA told him, you need to make $1 million in revenue for it to make sense. And I was like, that's completely inaccurate. This guy was missing out. If we didn't catch it, he's overpaying almost $100,000 to the IRS year after year after year. Okay. So again, note down if you're over that 50K. Let me check the chat if there's anything else that came up. If the net is less than 50K, but you make more than 50K revenue, it's all based on the net, because remember, your net income is what the tax is based off of. It doesn't matter if you made $1 million in profit, in $0 in net income, you're paying $0 in tax on that profit, right? Net income is the most critical measure of the tax payment that you're going to make. Okay. Okay. Next slide here. Mind the wealth sitting right under your roof. Okay, this one's huge. We covered optimizing your LLC, and I want to talk about the remaining ways to squeeze the juice out of your business in the form of missed deduction. So there's three big ones I'm going to go through. This is going to be the first one. Number one, home office. Okay. Number two, business travel. And number three, vehicle expenses. Let's start with the home office, the one you see right in front of you. You have to be insane if you do not have a home-based office in 2025. And by the way, that doesn't mean you can't have a physical office location. You can have both. And if your accountant has not told you this, I'm very sorry to hear that. Kind of normal, though. Having a traditional office doesn't exclude you from doing this. So you can have both. So who here has an office space they can use in their home? Just type yes in the chat. I mean, everyone's got to have an office space, right? So to run through an example, just so you can visualize this, Betty, the owner of a bakery, she's got an office in her bakery, right, in the back of it. But she also makes purchases from her home-based business. She processes payroll, right, administrative tasks. She produces marketing content from her home office. She can now consider that area of which she conducts business at the home to be her home office. So how does it work in practical terms? If your home office is 100 square feet out of 1,000 square feet, for example, right, that would be 10% of your home as a business expense. That 10% business use is what we use to deduct a portion of your rent payment, your electric bill, your utility, any other utilities, water, gas. Now, if you own your home, you can deduct 10% of the mortgage interest, the mortgage insurance, and some additional secrets that most accountants don't even know. You can also deduct 10% of your HOA, renter's insurance, property taxes, repairs and maintenance, cleaning expenses, security system expense, that 10% threshold for all of the relevant expenses that have something to do with the business use of your home. Okay, now one additional tip, the desk, my nice desk here, my monitors I've got set up, my lighting I've got set up, I use these all for 100% business. All of this is 100% deductible for me. So put yes in the chat if you want a home office, if you have one already. I think this is a large tip, completely missed out. Okay, home office, very big deal. Write this down. Okay, next one. We've got business trips, one of my favorite ones. Who here has traveled out of the state or the country and ever been like, you know, what would have made this trip a lot better? If it was deductible. Like trips and food just taste so much better when it's a deduction, right? So, okay, how do we actually do that in practical terms? Number two, or there's two rules, okay? Number one, the strange bed rule. And number two, the business intent rule. It's strange bed. It's not as weird as it sounds, I promise. All the strange bed rule means is that in order to be considered a business travel, you need to stay overnight in a strange bed. Not a stranger's bed. Okay, I don't advise that. That can be very dangerous. Just a strange bed. This can be a hotel. This can be a friend's home, an Airbnb, anything that establishes travel away from your home base, right? Okay, that's number one. Number two, how do we actually make this business intent? The IRS is very clear that you need documented intent of the business purpose of the trip prior to the trip, right? So we need the intention for this trip to be business. So how do I do this? Okay, well, here's a very easy way. There's two easy ways. Number one, if there are destinations you can think of where you're meeting clients, you're meeting vendors, you're visiting business conferences, and your primary intent of that travel now becomes for that reason. Now it is business intent and you're sleeping in a strange bed. You qualify. But what if you're in this situation, you're like, hey, Alex, I really want to go to Vegas, but I don't know anyone in Vegas. I really don't have any vendors or customers in there. Super easy workaround. You're going to go to a website like eventbrite.com or meetup.com, eventbrite.com, and look for conferences and events related to your profession in those areas. There are tons of those business conferences around. There are even organizations that let you take courses on cruise ships now with the ability to deduct the cruise. This is actually a real thing. So if you are thinking there's no way I can make this trip deductible, I'm telling you, you legally can. If you make it a business intent, right? You need to have business intent as the primary purpose. That is key. One more really cool rule you should know about this. It's called the 4 hour in 1 minute rule. What it means is when you're on a business trip and you spend 4 hours in 1 minute of the 8 hour total business day pursuing your trade or business activities, right? You're attending an event. That entire day is now counted as a business day. Why 4 hours in 1 minute? Because that gets you over that 50% threshold of the day of creating it a business day, right? So 4 hours, 1 minute, that entire day becomes a business day. Awesome, right? Okay. There's a lot of content to talk about with business travel. One more thing, one more cool tip I want to share. This is for foreign travel. So if your trip is in Japan, right? And let's say it's under 1 week. This only applies if it's under 1 week. And you conduct business for 1 day. Congress allows a 100% deduction for the entire transportation cost of the entire trip. That means, for example, if you left on a Sunday, you had a conference on Monday, you came back Saturday, the entire transportation cost of that trip becomes deductible for foreign trips. Pretty cool stuff. Guys, if you can put a wow in the chat, if that's pretty interesting. Researching this, and some of this I knew, some of these tips I found out recently. I think this is really, really interesting stuff. Put a wow in the chat if you're liking it so far. Okay, so to recap, we need two things. Number one, business intent. And number two, to sleep in a strange bed, not a stranger's bed. We can find events on sites like eventbrite.com or meet with existing colleagues, vendors, and customers. Okay, awesome. We are done the business travel part. Let's move to the next one. Vehicle deductions. This is the last of the big three we talked about. So many people have a misconception that in order to deduct your vehicle, your car must be 100% for business use. I get a lot of business owners that ask me that. Don't I need to put it under the business LLC for it to be business use? No, completely false. Even if your car is under your personal name, if you drive it for business, a portion of that car is a business deduction. Okay, great. So how does this work in practical terms? Let's cut the TikTok fluff. Let's get into actually how it works. It's super simple. Every single business mile you drive is a 70-cent deduction in 2025. Every year it goes up a little bit, 70, 72, 73 cents. It'll go up with inflation, right? But for 2025, it's 70 cents. So if you drive, for example, 12,000 miles throughout the year, you're picking up supplies, you're meeting clients, you're running business errands, that 12,000 miles translates to over $8,000 in deductible business mileage. And the vehicle does not need to be owned under the business. It can be under your personal name. It's actually preferred to be under your personal name unless it's 100% business use. Now, if you're like, okay, Alex, that sounds great in theory, but that is a pain to track. You're telling me I have to track my business miles? I've got a tip for you. Download an app called Mile IQ. I put it right there at the bottom of the slide. I don't have an affiliation. Mile IQ. What it's going to do is after every trip, the app is automatically going to ask you, hey, swipe left if it was business, swipe right if it was personal. Automatically, you're tracking. It's creating a log of business versus personal throughout the entire year. And you have IRS audit ready, bulletproof documentation that you can present of every single business mile that you drove. And if you think that could be a pain to do, I'm telling you, if you think about every swipe of your trip saving you thousands of dollars, the ROI is worth it, as you can imagine. And remember how we talked about having a home office, even though you already have, a traditional physical office? Here's another pro tip. That mileage that you drive from the home office to your traditional office, that mileage now becomes business mileage where it wasn't before, because technically when you drive from your home to your physical office, that's called commuting. They don't allow commuter miles as a deduction unless you have a home office. You're technically driving from business to business. Pretty cool stuff. So now all of those, and can you imagine how many miles you're driving from your home to your business? That's a big deal. So that's a lot of an additional deductions right there. Okay. Let me pause for a second. I know I just threw a lot of tax saving information at you. This information is worth thousands of dollars, seriously. So it's worth it to note this down, rewatch the recording later, make sure you're capturing all this, asking your accountant, Can I get a $sign in the chat if you're getting any value out of this? I haven't looked at the chat for a while. Let me check any new messages. Wow. Wow. So good. Downloaded. Awesome. $signs. Nice. Okay. Hopefully this is valuable. Okay. Next slide, guys. We just wrapped up the big three. Okay. Now, one caveat to this, not many accountants are going to talk to you about this. How do we actually bulletproof the records that we get from what we just talked about, right? It's all great in theory, but how do we actually document that? Okay. Easy way. And I do this myself, so I live by this. Does anyone, by the way, on the call keep physical receipts, like in a shoebox or something? Just say yes. There's no shame in it. I just want to make sure we're all living in the same century, right? I'm joking. Did someone say yes? No. Okay. Thank God. Huh. Thought someone said yes. Okay. So here's the news that's going to brighten your day. You do not need to keep receipts of any expenses under $75. Whew. That's a big relief. Now, there's only two exceptions. Hotel lodging. Okay. You need to keep those no matter what, which probably going to be over 75 anyways. And then meals you also should keep because you got to write on the receipt what the business purpose was. So, but everything else under 75, don't need to capture it. Do not waste your time on that. And obviously you're using your business card, right? When you're buying these business expenses. So your accountant is going to see that within the QuickBooks bank feed and capture that. So you're not missing the deduction. Just, you don't need to capture the receipt. Okay. Now, what about the receipts greater than 75? What's the easiest way to capture these? I'm going to give you the easiest pro tip humanly possible. Within QuickBooks, in which I know most of you are on QuickBooks, there is an email inbox that allows you to forward any receipt to that inbox. So for example, mine is Stronghold Accounting plus expenses at assist.intuit.com. Every time I have a meal, oh, look, there's me on the slide. I forgot I put that. There's me eating sushi and I'm taking a picture. This was after we shot the video promotion for the webinar. And I'm taking a picture of my sushi and I'm forwarding that to this. And by the way, QuickBooks is going to automatically scan it, capture the date, capture the amount, capture the vendor. Only thing for meals, you got to write what the business purpose was. Like, hey, meal about we discussed marketing for the business with a potential client, right? That's the only caveat with meals. And then now you have it saved in this file. IRS comes knocking, you've got the date, you've got the vendor, you got the amount, you've got everything you need. Okay, so no need for a shoebox. Let's keep it easy and efficient. That's what I'm all about. Okay, let me check the chat because I haven't seen anything. $74.99. Yes, let's keep it at that. So we don't need to keep the receipts. Okay, that concludes the tax saving portion of the masterclass. Wow, we're exactly at like 30 minutes per. This is a perfect timing. I've never done this full run through, so I've timed this perfectly. Awesome. Okay, now we're about to get into some of the juicier stuff. We're going to talk about profit optimization. Type profit in the chat if you're ready to move to the second half of the masterclass. Let me take a sip of coffee to take a breather. Okay, we're done the tax saving piece. Okay, let's move on to mistake number 3, not understanding the profit engine of your business. So let me show you an example with real data. Okay, I'm actually going to stop the screen share of my slides and I'm going to present real data here. Okay, let me share this window. Okay, now I want you to imagine, let me pull it up here. Okay, it is the 10th business day of the following month, right? I want you to imagine this. You just got your financials from your accountant. And this is what you get in your inbox, something that looks like this. This is an export from QuickBooks. Can you tell me in 10 seconds what actionable data you're getting from this? I can't even tell you, and I've seen hundreds of P&Ls. You're going to do a lot of hard work to dig into these details and get any kind of insight from this cluster of information. Okay, now I want to transfer over to a simplified version. Oh man, that's much better. Clean, simple. So this is actually a simplified, much cleaner version of the same exact financials we just looked at. I can actually see a picture of my business that's not overwhelming. Why is that so important? After doing these financial reviews, like I don't know how many I've done, maybe 1,000 at this point. The second confusion sets in for the business owner, you've lost the ability to take the useful nuggets of data, especially the business owners that have no accounting, finance background. The second you confuse them with data, they're just, they don't understand. You need to simplify this and you need to feed it to them in a very simplified format. And this is with anything, right? If I want to understand marketing, I want to understand it in a simplified format. So I want to give you a quick walkthrough of the way this is laid out so you can get an idea. So number one, we obviously start with total revenue. Right after that, we have our COGS, our costs of goods sold. So for example, if I'm a construction company, right, my COGS are my supplies and materials for the jobs, my subcontractor expenses, my equipment rental, anything directly attributable to producing that revenue right above it. That is what a cost of goods sold is. Okay. After revenue and cost of goods sold, I get what's called product margin. This is purely the revenue minus the direct COGS, no labor. We segregate labor right after that. So this is where your direct labor comes in. This is for employees that are actually producing revenue on the job site. For example, if it's a construction company, we've got some lawn care companies in here. We've got home service companies. Anyone actually going to the home producing revenue is your direct labor. Okay, then after COGS, after direct labor, I end up at gross margin. Let me emphasize gross margin because this gross margin is like always glossed over for some reason. Maybe it's because it's gross. I don't know. People don't like it. It is not gross. Gross margin is the core engine of your business. 9 times out of 10, if I see a business struggling, it's because of the gross margin. You're not pricing right. Your cost of goods sold is too high. Your direct labor is not as efficient as it should be. I'm telling you, gross margin is your core engine. If that is not right, nothing else is going to work. And 9 times out of 10, that is what is causing the issue with your profitability. Okay, so that's gross margin. We're going to circle back to that, but I just want to continue down here so you can see operating expenses. This is everything outside of your direct labor and outside of your cost of goods. So, for example, facilities, right? That's your rent, your utilities to maintain the day-to-day operations. You've got marketing and advertising. Your administrative labor. This is all of the labor that's not direct. So management salaries, right? Project managers, your assistant, your office clerk. This is administrative labor, not directly producing revenue. Payroll tax and benefits, and then another category. We're trying to keep this very simple. All the way at the bottom, you've got your net income. When you think of net income, I want you to visualize a net catching all of the profits as they trickle down from the top. That is your net income. If you notice, I'm not really covering revenue in depth because revenue is vanity and profit is sanity. I'd rather run a $500K a year business, keeping 20% of the profits, than a $2 million revenue business with razor thin margins. I will take the first option any day of the week because number one, I have less clients that I have to deal with, less headache and less moving parts, less staff. Like you guys know how difficult it is to manage staff. I mean, it takes a lot of effort because you're now in charge of these people. So I'd rather be a lean, mean business with less stress and massive margins, quality over quantity. And I'm not saying you should cut your business in half. I just want to emphasize the quality over quantity. So to recap, this is the difference between bad data, okay, no actionable aid. I don't know. What is this telling me? I don't know. Versus good data. I want a simple, and also like visuals are nice too. So to be able to see a chart of this is very nice. This is by the way, just a dashboard we use for our clients. Same thing we just looked at. This is your profit margin trifecta here. This is the next thing I'm going to talk about. We just looked at that on the real P&L. Product margin, number 1, gross margin, number 2, and net margin. That is your profit margin trifecta. If you can understand your profit margin trifecta, you have covered the basis of your entire profit margin of your P&L. You know from the beginning after COGS, you know after direct labor, and you know after operating expenses. You need to understand your profit margin trifecta. Okay. Now, the reason why it's so important is because most companies are not segregating your costs of goods from your direct labor. Surprisingly, they're kind of mushing these together. So you've got revenue, direct costs, and then gross margin. They're not segregating these. But if we don't segregate these, I have no idea what my product margin is. I have no idea what my direct labor as standalone looks like. And I don't get like I said, this is the engine. So if I can't take the engine apart, I really don't understand what's happening with the business, right? So why do we separate the cogs from direct labor? Well, as Greg Crabtree says, the author of Simple Numbers, check this book out. Labor is the only cost, okay, that comes to work with an attitude. Your cogs don't come to work with an attitude. They don't come to the office inefficient, feeling tired that day. Like your labor has a lot more of an ability to be optimized than your hard costs in most scenarios, right? So when you're talking about hard costs that you purchase from a vendor, there's much less wiggle room, right? And there's no like they're not a human being. It's just a hard cost of goods sold. But your direct labor, they're a human being. And you have the ability to help optimize that because there may be inefficiencies there, which is mistake number 5. We'll drill into that more. Okay. So what should you be targeting for your, let me go back to the dashboard so you can see this. So you've got your profit margin trifecta, exactly what we talked about here. What should you be targeting when it comes to your profit margin trifecta? So let me see here. Where'd my notes go? Okay, so to give you a visual on average, you can expect, and by the way, every business is different. Every industry is different. That's why it's very hard to give you a direct answer, but I want to give you a kind of a framework so you can understand where your margin should be. So to give you a visual on average, and let me go back to the P&L so you can see. And this has like your targets here that we look at with our clients. So we set customized targets that we can analyze. But typically, for your gross margin, after your direct labor, after your cost of goods, that's going to eat up about 50% of your revenue. So after $1 million in revenue, for example, you're going to be left with $500,000. Okay. Now, in terms of your operating expenses, you can expect around 30 to 35% of revenue to be eaten up by OPEX, operating expenses, leaving you at the end of the day, when I go down to your net margin, with an ideal 15 to 20% net at the end of the day margin. For those that don't know, when I say net margin, I just mean we're basically taking the net income divided by your revenue. So if you had 150K in net profit divided by $1 million in revenue, that yields me 15% net margin. Okay, that's all that means. It's just super simple math. Okay, let's take a mental break and go back to the pretty dashboard here. So we've got our profit margin trifecta. This is a snippet of what we review with our clients every single month. So we talked about the trifecta, and it's going to tell you if you're in good condition, you're in great condition, you're in a cautious position, right? And you may be wondering, what does the rolling 3 and the rolling 12, what does that mean up here on the header? All that means is that for rolling 3, for example, I'm combining the last 3 months of financials into one column. And rolling 12 is the same thing. I'm combining the last 12 months of data into one column. So for example, if I did rolling 3 for June, it would include April, May, and June together. But why? Why are you doing it that way, Alex? I really don't understand. Because when you look at the financials 1 month at a time, it is too narrow to get accurate data from that. You may have a huge boost of sales in June, a massive unexpected bill that's going to throw your profit margin trifecta out of whack when you look at it on a monthly basis. So the reason we look at data this way is because it allows you to smooth it over, the ebbs and flow, the natural ebbs and flows month over month. And you're able to consolidate that into one column and get a real accurate profitability assessment of where the business is at. So that's why I think looking at minimum a rolling 3 basis and a rolling 12 basis is essential. So, September month end, I'm going to review the September, including the last 2 months together, right? To smooth everything over. Okay. Let me take a breather. Type yes in the chat if this is helpful stuff. We're just scratching the surface here. Let me go into my next slide here. Let me stop sharing and go back here. Okay, we talked about segregating the cost of goods from the labor already. So We already see from the profit margin trifecta why that's so important. Let me check the chat if there's anything. Okay, looks like we're in good shape. Okay, now mistake number 5, not tracking labor efficiency. This is one of my favorite metrics. For those of you that have revenue producing employees, even if you don't, even if you yourself are the revenue producer, right? Like for my accounting firm, I work with my clients as well. So I'm technically a revenue producer as well. Even if you don't have employees, I would take notes because it's super relevant for you, even as you grow. So what is labor efficiency? In essence, labor efficiency is answering the following question. For every dollar that I spend on my employees, what is the product margin? Remember, we just looked at product margin, revenue minus cost of goods sold. What is the margin that I get back for every dollar that I spend on my employees? So for example, let me actually go through a real life example. We were looking at this P&L here, and let me share that again so you can see some real data. Okay. So, okay. So in this example here, I'm going to highlight this section here. You see direct LER. That means labor efficiency ratio, 2.6, also known as $2.60. Okay, what does that mean? So in this scenario here, I spent $1 million on my direct labor, as you can see on this line item. And I'm left with $2.8 million of product margin after my cost of goods. Okay, million direct labor, 2.8 million product margin. So if I take 2.8 million divided by the million in direct labor, I'm making $2.60 for every dollar that I spend on my direct labor. Pretty good trade-off. I spend $1 on labor, I'm getting back after my cost of goods $2.60. But the way this formula is framed allows you to really conceptually understand an immediate ROI on your labor versus the return on that labor for your business. I want to give you an example of why this is so powerful. So when we ran the figures for direct labor efficiency for one of my construction clients, we were stuck at $2 of labor efficiency ratio. So $2 for every dollar they spent on direct labor. So we targeted $2.50. And you might think, oh my gosh, that's just a 50-cent difference. That's really not much, right? We're talking pennies here. So that 50-cent difference in direct labor efficiency, $2 to $2.50, yielded them an additional $200,000 of profit over the course of a full year. That 50-cent difference, $200,000 in profit. But how did that actually happen? Like, how did that actually occur? So the first step that a lot of people get wrong is actually tracking it. Have you ever noticed, and a lot of business owners tell me this happens, when you start tracking something, whether it's a business metric, whether it's a personal metric like your sleep score or something like that with your Whoop band, somehow by starting to track it, it magically just starts to get better. It's a very real thing. It's called the Hawthorne effect. Essentially, when your executive team and your employees know that you're tracking a certain metric, their efforts of performance now gravitate to optimize that metric. Had you never presented that in the first place, nothing would have changed, right? That's why step number 1 is tracking that metric and having them know you're tracking that metric. And then we can start to play with the 2 variables, our product margin, right? Revenue minus COGS, and our direct labor cost. Those are the 2 inputs that we can lever to improve our direct labor efficiency. It's an efficiency game, right? So either I can, number 1, produce the exact same amount of revenue with less costly labor, or I can produce more revenue with the same amount of labor, okay? But actually seeing this metric on paper each month, you're now one massive step ahead in the right direction to make a world of difference of your profitability. So just to give a recap, your direct labor is quantifying how much product margin, right? This piece here, my revenue minus cost of goods, you are producing for every dollar in direct labor that you're spending. So if you have employees and you're not looking at this monthly, you could be missing out on $200,000 of additional profit, like my construction client. To take it a step further, sharing this publicly, this metric on a public level with your employees, having an open dialogue on this, maybe even incentivizing them with a small bonus tied to this metric, that is going to boost the efficiency of this labor. I've seen it happen so many times. That is why that metric is so key, because a lot of times, you see your profits, you see your income statement, right? You get good data. That's step number one. But then it's like, okay, how do I actually do that? This is how you do it. Labor efficiency is how you do it. Okay. Does that all make sense? Type a yes in the chat if I explain that well. I know labor efficiency can be a little bit weird of a metric, but hopefully I explained that well enough. Let me go ahead and stop sharing this and put my presentation back. Okay. Okay. So we just went through a lot of valuable information. We're going to take a quick poll. Okay. What has been your favorite topic so far? Home office, turning a vacation into a write-off, the vehicle, bulletproofing your records, the profit margin trifecta, labor efficiency. What's been your favorite one so far? I got a lot for profit margin trifecta. Okay. Anyone else? You guys didn't like the tax deductions? Tax is more boring than profitability, right? I'll leave this poll open for another few seconds. Really, bulletproofing your records. I thought that would be last place, honestly, because that's more of the boring part. Interesting. Okay, more profit margin trifecta. No home office. I guess everyone has that already, maybe. Labor efficiency. I'm shocked no one picked that one. Okay. So one of the things I want to mention is that everything we talk about today goes out the window if we don't have accurate data at the foundational level, right? So when we onboard a new client, we do what's called a financial health assessment. We deep dive into their QuickBooks file, and we want to identify any red flags, any areas to look over, any opportunities in the financials. And we regularly see $50,000 to $100,000 of misstatements when we onboard a new client. Some of these are prepared, maybe they're doing their own bookkeeping. Maybe they have a firm that's doing their bookkeeping, even an established firm. I've seen very large accounting firms that a little bit over a year ago, we had one client with $1 million in misstatements from this firm. Oh, let me end the poll here. Okay. Yeah, the one of the recent large errors I saw was $500,000 that they forgot to add as a deduction on the P&L. That $500,000 deduction meant that they paid over $150K to the IRS. And that was 3 years ago. So he couldn't even try to go back and do that without looking fishy. Imagine what you could do as a business owner with an additional $150,000 of cash flow. The last two slides I have here is just to let everyone know what we do. If you're not aware, we have a profit mastery program, which is essentially a dedicated accounting team in your back pocket. So as part of the profit mastery program, you're getting the weekly bookkeeping done. You're getting CPA reviewed monthly financial statements that are audit ready. And we really emphasize the strategic component that we kind of looked at here today. Simple, coachable targets that we can reduce your tax liability and maximize the profitability of your business engine. But before we work with any client, I mentioned the financial health assessment, which is essentially just a CPA review of your QuickBooks file to identify any of the red flags. Okay. The last slide I have here today is the part of that for today. Everyone live on this call, if you're interested in seeing the current health of your QuickBooks file, I'm personally going to be doing the financial health assessment for everyone's QuickBooks. We're going to cap it at 15 health assessments because it does take a lot of detail for me to go in and make sure I'm capturing all the red flags that occur. So we regularly price these for non-clients at $500. So we have this at $99. It's supposed to be super affordable. So if you're looking to reserve one today, I have a call to action here. Where is it? Boom. You should see a pop-up come up. In terms of when you go to this link, it's going to ask you for the payment information, and then we're going to capture your email and get QuickBooks Access. We'll send you instructions of how to get QuickBooks Access. Super simple. And then we'll get that over to you within 24 to 48 hours at most. That's also alongside the health assessment comes a customized proposal of what it looks like to work with us on a monthly basis. And my contact information is here at the bottom, Alex at Stronghold Associates, in my direct line. If you have any specific questions pertaining to what we talked about today or pertaining to the health assessment, and if you know any business owners that need something like this, feel free to connect them with me directly at alex at strongholdassociates.com. We are wrapping up 10 minutes early. Beautiful. I was hoping that I didn't go over today. So that's going to conclude the webinar for today. You're going to get a recording in your email shortly of everything we talked about today that you can rewatch. But thank you all so much for joining me today. I hope this was as valuable as I wanted it to be. I've condensed as much as I could. And thank you so much for joining us today. And that concludes the webinar. I had a lot of fun doing it, so I definitely want to do another one in the future, perhaps a different topic, or perhaps we'll redo this one. But there's a lot of information that I want to share and make sure I share with everyone, because there was a lot of content I had to remove from this because I could only fit so much within an hour. So thanks everyone for joining us. Really appreciate it. And that is going to conclude the webinar. Thank you so much and have a great rest of your day. Take care.